Wall Street is looking at a mixed open after the Federal Reserve took aggressive action to fight record high inflation. The central bank raised interest rates 0.75 of a percentage point yesterday. That is the biggest hike since 1994. So its goal is to slow spending without causing a recession. Carter Evans explains how the move could impact American families.
It is essential that we bring inflation down.
The aggressive move from the central bank is urgent, according to Fed Chair Jerome Powell.
Inflation has obviously surprised to the upside over the past year, and further surprises could be in store.
The last time the Fed raised rates 0.75 of a percent was in 1994, when inflation was only 2.7%.
In the Fed's view, there's too much spending going on.
Nick Bunker's an economist with job search site Indeed.com.
This is a different position than the Fed had just a couple of months ago.
Exactly. Their expectations haven't come true, and inflation is now very high, 8.5%.
The Fed's move will make borrowing money more expensive. With rate hikes of 1.5% already this year, a loan for the average new car price of $47,000 will cost almost $60 a month more in interest than last year. More expensive loans could discourage spending and reduce the insatiable demand now driving inflation to 40-year highs. But higher interest rates won't lower gas prices, now over $5 a gallon nationally. President Biden called on 7 U.S. oil refiners to ramp up production and stop making historically high profit off Americans. The painful price increases are already too much for some people on fixed incomes, like 70-year-old Bonnie Gilbert in Omaha. Her husband died last year from COVID.
Now I'm not going to be able to retire because how am I going to retire with just a Social Security?
To make ends meet this month, she's having a garage sale.
And high prices might already be having an impact on consumer spending. It declined slightly in May, unexpectedly. As for home buyers, well, the Fed chair says prices may remain high because of a lack of inventory, even though the average mortgage rate is now close to 6%. Carter Evans, CBS News, Los Angeles.
So for more on this, we want to bring in Gargi Chaudhuri. She joins us this morning. She is the head of iShares Investment Strategy Americas for BlackRock. Thank you so much for joining us. All right, so let's get into this. Interest rates are going up, so it's more expensive to borrow. Does that mean this is now a terrible time to buy a house, build an extension on your house, buy a car, or should you get in now because who knows what's coming up down the road?
Sure. So good morning, and thank you for having me. So as you pointed out, interest rates are going up. And yesterday we heard from the Fed chair that they're actually going to continue to grow up even further. But I will say one thing. The markets are forward looking, right? So much of the interest rates going up is already actually in the pricing in the markets. To your second part of the question, I mean, look, mortgage rates have already moved pretty significantly. It's now over 6% when you look at that 30-year mortgage rate. And at the same time, prices haven't yet quite adjusted. So it's a pretty, if you think about it, it's a pretty bad time to buy a house because not only haven't prices fallen yet, they might adjust in the future. At the same time, mortgage rates are very high. So I would say that, if you're not in a rush, you could wait a little bit, which is what I think we're already seeing a lot of investors and a lot of consumers do that, waiting a little bit. But at the same time, I would still say that, we don't know what's coming in the future. If you need to have a home, you can be a little bit more patient. But also remember that as interest rates are rising, there are some benefits. You are getting to have more in your savings account. You're earning a higher amount on your savings account.
And I actually thought one of the things you were going to say is typically when interest rates go up, in terms of housing anyway, the price of houses go down. So if you can hit that sweet spot where the interest rate isn't too high, but the houses have dropped in price, you might actually get a pretty good deal.
Right. And more importantly, that will happen, but we haven't seen that happen yet, which was what I was saying around. You could be a little bit more patient. Wait for those prices to come down because obviously, there was this huge move after the pandemic towards bigger houses, better houses, extending your home because we were spending so much time at home. So there is that little demand-supply mismatch. Let's wait a little bit, let that shake out, let those prices come. It's actually a good thing. We want to see that froth removed from the market. We want to be in a world where everyone can afford the houses that they want to be able to afford. So let's wait a bit. I think that's going to happen. You should still definitely continue thinking about owning a home and investing in your home and investing in the markets. But I think there's time to be patient.
What did you make of the Fed's announcement yesterday? Yes, we saw the points at 75 basis points go up, but I felt like the chair was trying to sort of take the sting out of it a little. Even though he warned there would be more hikes,
Right.
he kind of suggested they're not going to be like this. He didn't say that outright.
He didn't
but,
say that.
yeah.
So what he did say that was that, in the future, it could be 75. It could also be 50. So he opened the window for it to be lower than 75. He did call this type of rate hike unusual. And then what I think is the most important point that he made was that they're not going to try to cause a recession, but it is paramount to them that inflation starts plateauing and then decelerating. And right now, that's not happening. We know that if you're going to try to buy gas or you're trying to buy eggs or dairy, the prices are going up. So they first need to see just a stabilization and then a move lower. And even though they're not trying to cause a recession, at this juncture, they do expect unemployment rates to move a little bit higher. So what I make of that is that you have to be a little bit more defensive. If you're an investor, please stay invested in the markets, but perhaps be a little bit more defensive in where you're going in the markets. So that was my one big takeaway, that while they're not trying to cause a recession, some of the actions that they have to take might have spillovers.
You always hear in some circles anyways that credit is king, that it's not about the money that you have, but the credit that you're available to take advantage of. I think that changes now when the interest rates go up. So if you're looking to sort of save your money,
right,
is there a good savings account that will benefit you? Or maybe for regular folks, it doesn't really make that much of a difference? I don't know.
I would just say, we're lucky enough to be in a position where you're earning something on your savings. So if you are, if you have some cash on the sidelines, you can actually, just be in 1 or 3 month paper. ICSH is a iShares ticker, and you can earn some yield on that. It was earning like 4 or 5 basis points, and now you can certainly start getting closer to 150, 175, and even higher as interest rates go higher towards the end of this year. So I think that's really interesting, and taking advantage of that. So making sure that, it's not cash under the mattress, so as to say.
Right.
I don't know if people do that, but making sure that your cash is doing a little bit of work for you, because it can now. You're taking a very little amount of risk, but even if you go out a few months, or if you want to lock up your money for maybe even 2 years, you can earn something spectacular. I mean, 3%. We wouldn't have thought of that 3 years ago, 2 years ago.
Not at all. Gargi,
Yeah.
thank you very much.
Thank you, Anne-Marie.